Hey everyone, welcome back to Corporate Decoder, the place where we pull back the corporate curtain and sometimes we find gold and sometimes, well, let's just say it's a bit more Bitcoin shaped. Today we're diving into a filing from Subversive Bitcoin Acquisition Corp. And trust us, this one is a wild ride. Think SPAC, think Bitcoin. And think a whole lot of what ifs. We've got a preliminary prospectus packed with potential strategies and plenty of risks, especially for anyone thinking about investing. Alright, so this is an amendment to a registration statement filed with the SEC, the US Securities and Exchange Commission. Think of the SEC as the referee for the stock market, making sure companies play by the rules. This filing is essentially their way of saying, hey, here is a heads up about this IPO, and it is amendment number 1. Meaning they've already tweaked things once. Right off the bat, the name tells you a lot about their focus, doesn't it? Subversive Bitcoin Acquisition Corp is a blank check company. What's that? Well, imagine a company that's basically a pot of money raised from investors specifically to go out and buy another company. They don't have an existing business to speak of. Their whole purpose is to find a business to acquire. And as the name suggests, their strategy involves Bitcoin. So here is the deal. This company, Subversive Bitcoin Acquisition Corp, set up in the Cayman Islands, is looking to merge with or buy another business. They don't have one picked out yet, and they have not even started talking to anyone seriously about buying a business. They are in the hunting phase, and they have all this investor money ready to go. This is their big debut, their initial public offering. For every $10 you invest, you get one Class A ordinary share and half a warrant. Now, that warrant gives you the right to buy a share later for $11.5. So, they're selling these packages called units, and each unit is made up of a share and a piece of a warrant. You need 2 of those half warrants to make a whole one to buy a share. Here is where it gets really interesting. A big chunk of the money raised, $90 million to be exact, is going into a trust account. This money is meant to be safe, invested in super secure US government stuff, or just held in cash. But the twist, another $10 million of this IPO money is going into another trust account, specifically to buy Bitcoin. This is not typical for a SPAC, and they admit it in the filing. Most SPACs keep all their IPO money in cash and government securities, even the interest earned on the safe money and any wiggle room from their Bitcoin holdings. They plan to use that to buy more Bitcoin and pay taxes. This whole strategy shows they are really leaning into the Bitcoin aspect. So, if you buy shares in this IPO, you have a special right. When or if they buy another company, you get to decide if you want your money back. And get this, they will pay you back not just for the cash part of your investment, but also a share of whatever Bitcoin they still have left. This is a pretty unique redemption right, tying your refund to both their cash and their Bitcoin holdings. Now here is the deadline. If they don't find a company to buy within 24 months, that's 2 years they have to give all the IPO money back to the investors. And again, this includes a share of any Bitcoin they still hold. It is essentially a guarantee that you'll get your initial investment back plus a piece of any remaining Bitcoin, unless creditors step in, which is a whole other can of worms. The company sponsor, these guys at Subversive Bitcoin Sponsor LLC, are buying a chunk of these units themselves, about $3.5 million worth. This shows they are putting their own money on the line, which is usually a good sign, but they are buying them on the same terms as the public investors. And they own these founder shares, almost 3 million of them. These are special shares that give them different voting rights, especially regarding who controls the board of directors, and they were bought for a ridiculously low price, about 9/10 of a penny each. This is a classic SPAC move that can lead to significant dilution for public investors. These founder shares bought super cheap will convert into regular class of shares when they buy a company. The catch is, there are anti-dilution clauses. This means if the company issues more shares later, especially during the business combination, the number of class of shares these founder shares convert into can actually increase, meaning the sponsor could end up owning a bigger piece of the pie than they did originally, diluting everyone else. It is really important to understand that if the company issues more shares later, especially for the business combination, the sponsor's founder shares could convert into even more class of shares, magnifying that dilution. So, they paid a grand total of $25,000 for almost 3 million shares. You can see how the public shareholders are on the hook for a much higher price. This difference is a major source of dilution. Now let's look at the money side. The underwriters, the investment banks helping sell these shares, get about $4.5 million up front. But here is the kicker. Another $3.5 million in commissions is being held in trust. This deferred commission is only paid out if and when Subversive Bitcoin successfully buys another company. If they fail, The underwriters don't get that chunk of money. This is meant to align the underwriters' interests with completing a deal. This sentence is crucial because the sponsor got their founder shares so incredibly cheap. Your investment in this IPO is going to be diluted right from the start. That means your ownership stake is smaller because of how many cheap shares the sponsor already owns. The table shows this clearly. This table is where the real story unfolds. It's breaking down the net tangible book value, or NTBV, per S-share. Basically, it's showing you what your investment is worth on paper after all the costs and considering different scenarios, like if a lot of people redeem their shares. Look at the difference between NTBV and offering price column. Even in the best case scenario, assuming the underwriters buy all their extra shares under the over allotment, the NTBV per S-share is $7.5, but you paid $10. That difference is dilution, and it gets much worse if many shareholders redeem their shares. In the maximum redemption scenario, the value per S-share for remaining holders could be as low as negative $0.67, meaning they would lose money even before the company buys another business. This is the net tangible book value. It's like asking if the company suddenly had to sell all its tangible assets and pay off all its debts right now, what would be left over per S-share? Here, it's $7.5, but you paid $10. That's a $2.5 difference per S-share, wiped out by dilution and offering costs. This $3.09 represents the immediate dilution you face just by buying into this IPO at $10 a share. Out of your $10, almost $3 are gone due to offering expenses and the sponsor's cheap shares before the company even finds a business to buy. This is the really scary part. Assuming maximum redemption, meaning a lot of investors want their money back, the net tangible book value per S-share could actually become negative $0.67 in losses per S-share. This calculation doesn't even account for the volatile Bitcoin strategy or potential warrant exercises, which would further dilute this. And now, the risk factors section. This is where companies dump all the ways things could go disastrously wrong. And let me tell you, this filing has a lot. They are very upfront about the risks involved with a SPAC, especially one with a Bitcoin strategy. One of the key risks, they might not even let you vote on the company they decide to buy. They can use a tender offer instead, which means you only get a say by redeeming your shares for cash. This is a big one. They are hammering home the point that the sponsor got their founder shares for practically nothing. Even if the company they buy performs poorly and the stock price tanks, the sponsor could still make a huge profit while public shareholders could lose their shirts. Here is the elephant in the room, Bitcoin. They admit it's volatile, that it doesn't pay interest, and that it can seriously mess with their financial results and stock price. They are putting a significant amount of IPO money into Bitcoin, which is a high-risk, high-reward move in a company whose primary goal is to buy another company. To try and soothe some worries about creditors, the sponsor has agreed to cover any shortfalls if claims against the company drop the trust account below $9 per S-share. But here is the catch. They're not sure if the sponsor actually has the money to cover that, and it's a pretty big if. They are not kidding about the Bitcoin volatility. They mention price swings of over 125% in a year, huge drops, and how this price action directly impacts their own stock value. They even mention past events like the FTX bankruptcy and what it did to the market, because they will be holding Bitcoin after this IPO. Their past financial reports don't show how wild their future earnings could be due to Bitcoin's price swings. Now, with new accounting rules, they will have to report these fluctuations, meaning more volatility in their reported profits. This is a crucial external point. They're worried that because Bitcoin exchange traded products, or ETPs, are now approved and trading, investors might choose those instead of buying into their company for Bitcoin exposure. This competition could hurt their stock price. And get this, you, the public shareholder, have almost no say in who runs the company until they actually buy another business. The sponsor gets to pick all the directors, so you might not have a vote on the board until after the big acquisition. Let's look at who owns what. The sponsor, Subversive Bitcoin Sponsor LLC, will own about 21.8% of the company after this offering. That's a huge chunk, giving them a lot of control. Again, that incredibly low price for the founder shares paid by the sponsor is highlighted. It's the core of the dilution problem for public investors. If the company doesn't find a business to buy, these founder shares in the sponsor's placement units become worthless. But if they do, the sponsor stands to make a massive profit even if the public shareholders lose money. This is the punchline for dilution. You are buying in at $10 a share potentially, and a large portion of the company is already owned by people who paid pennies. Dilution is basically the reduction of your ownership percentage due to new shares being issued. Let's break down that net tangible book value, or NTBV. It is like a measure of what your shares are actually worth if you sold off all the physical assets and paid off all the debts, then divided it by the number of shares here. Because of expenses and the structure, the NTBV before the offering is actually a negative number, meaning they owe more than they have in tangible assets, even before a business is acquired. This table from the dilution section is key. Remember that offering price of $10 per unit. Look at the NTBV per S-share, even if no one redeems their shares, meaning things go well and they find a business. If the over-allotment option is exercised, the NTBV per S-share is $7.5, meaning you paid $10 for something worth $7.5 on paper right away. If many people redeem their shares, that NTBV plummets, making that initial purchase look even worse. They have the ability to issue a massive number of shares, far more than what is being offered now. This means they could potentially flood the market with shares during a business combination, which would severely dilute your ownership. These founder shares have a lock-up period. The sponsor can't sell them for a year after the business combination, or until the stock hits $12 for 20 days, or until the company winds down. This is standard practice to prevent immediate selling pressure, but it also locks up a large chunk of shares controlled by the insiders. The underwriters themselves might do some tricky market maneuvers, like short selling or stabilizing the price. This is normal in IPOs, but it means the initial price might not reflect true market demand, and these activities could artificially prop up the price early on. The company can pay its own sponsor and executives for various services, like office space and even advisory fees at the time of the business combination. These fees aren't capped and come from money outside the trust account, which is good, but it still means insiders can get paid handsomely, potentially even if the deal doesn't work out for public shareholders after the business combination. The auditors with Smith the Brown PC have issued a report with a big warning, substantial doubt about the company's ability to continue as a going concern. This means they're not sure the company will survive long enough to achieve its goals without getting that IPO money and finding a business to buy. It's a serious flag. Let's look at the balance sheet. As of late July, they had almost no cash, just $25,000 in prepaid expenses and $152,000 in deferred offering costs, which are basically expenses they've paid already for this IPO. Their total assets are around $177,000, but look at their liabilities, over $200,000, even before the IPO. They were operating at a deficit, just under $180,000 in total assets. That is for a company trying to buy another business, potentially a big one, and over $200,000 in liabilities. This means their liabilities exceed their assets, hence the shareholder deficit, and an accumulated deficit of nearly $50,000. This means they've spent more than they've brought in since they started. This is typical for a shell company before an IPO, but it underscores their pre-IPO financial reality. Their statement of operations shows a net loss of about $48,000 for the period ending July and about $29,000 for the period ending June. These are just basic operating costs before any real business activity happens. They haven't made any money yet, which is expected for a SPAC before it acquires a target. The company's main plan is to find a business to buy using the money from this IPO. They openly state they haven't found any target and haven't even started serious talks. They plan to put most of the IPO cash into a trust account, $90 million into a cash account and $10 million into a Bitcoin account. They are emphasizing that investors will get a chance to redeem their shares if they don't like the business combination, either by voting or through a tender offer. This redemption right is a key feature of SPACs for investors worried about the sponsors picking a bad target. Crucially, the sponsor and their inner circle are waiving their redemption rights for their own shares. This means they are fully committed to the deal and won't bail out if things get dicey, relying solely on the success of the business combination. It's a commitment, but also a potential conflict of interest. This is where we see the details of the sponsor's deal. They bought founder shares for just $25,000, or about a penny a share. Then, a small capitalization event added more shares, but still at a tiny fraction of a cent. This extreme low price for founder shares is a huge red flag for dilution. The shareholders' deficit section shows a negative equity. This means their liabilities are greater than their assets. This is expected for a company before an IPO, but highlights their pre-deal financial state. They're an emerging growth company and a smaller reporting company. This means they get to follow fewer rules and reporting requirements, which can make them seem less transparent to investors. They're also delaying adopting some new accounting standards, which adds another layer of potential complication when comparing them to other companies. And finally, let's talk about the underwriters, the ones actually selling this deal. Notably, one of the directors, Michael Ash, is an affiliate of Galaxy Digital Partners LLC, which is one of the underwriters. This is flagged as a conflict of interest under FINRA rules. Now, for my take, Subversive Bitcoin Acquisition Corp is rolling the dice big time. They're aiming for the hot crypto and blockchain sector, and they're not just holding cash for their acquisition strategy, they're actively planning to buy Bitcoin with IPO money. That is a bold, and frankly, a very risky play in the SPAC world. The dilution from those founder shares is massive, and the potential for the sponsor to profit, even if public shareholders lose money, is a serious concern. Their financial tables grimly illustrate the dilution and the negative tangible book value even before a target is found. The auditors are clearly worried about their ability to even survive, but here is the flip side. If the crypto market booms, and they manage to acquire a successful crypto company, this could be a rocket ship. The leadership team has deep experience in finance, and some have backgrounds in special purpose acquisition companies, which is a plus. However, the unique Bitcoin strategy introduces a whole new level of volatility and regulatory risk that most SPACs don't have. It's a gamble on two fronts: finding a good company and hoping Bitcoin does well. For investors, this is not for the faint of heart. You're betting on the sponsor's ability to navigate both the SPAC acquisition market and the notoriously unpredictable crypto market. The potential for high reward is definitely there, but the risks are equally, if not more. Significant, the high dilution and the existential risks highlighted by the auditors mean you're taking on a lot of uncertainty. Alright, that is our deep dive into Subversive Bitcoin Acquisition Corp. What do you think about this aggressive Bitcoin and SPAC strategy? Does it sound like a revolutionary move or a recipe for disaster? Let me know your thoughts in the comments below. If you found this breakdown helpful, smashing that like button really helps us out. And if you want more insights into corporate filings like this, make sure you subscribe to Corporate Decoder. And don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and we'll see you in the next decode.